The end of each accounting period, the general ledger must be prepared for the next accounting period. We call that the closing process, and it's like a reset button for all temporary accounts in the financial system. To use a cooking analogy, closing entries in accounting are like washing your dishes after a meal. You aren't throwing away the pots, pans, and dishes, you're just cleaning them up for the next meal. In many companies, this process is automated and closing entries are completed with the click of a button. But it's not always as easy as that. The more complex an organization is, the more complex the closing process can be. That is especially the case when the company is a multinational company where accounting teams in various countries and different time zones close their ledgers over the course of multiple days. That said, let's get started with the manual process of recording the closing entries so that you are aware of what an accounting system is supposed to do for you. Journalizing and posting the closing entries is step 7 in the 9-step accounting cycle. The important takeaway is that closing entries zero out temporary accounts in the general ledger, a reset to zero, so that the accountants can report on each accounting period separately rather than commingle the results from one with another accounting period. To use that cooking analogy again, you wouldn't want leftovers from your prior meal on your dishes when you're cooking your next meal. That is why we close the temporary accounts so that these accounts have a zero balance at the end of the accounting period. Just a reminder, temporary accounts include all income statement accounts as well as owners' withdrawals and dividends. And there are 4 steps that accountants must take to complete this closing process. In step 1, we'll close all revenue accounts and those income statement accounts that have credit balances to an account called income summary. As part of step 2, we close all expense accounts and those income statement accounts with debit balances to the account income summary. In step 3, we verify that the balance in the income summary account agrees with the net income from the income statement, which tells us that we've closed all income statement accounts. And only then do we close the income summary account to the capital account. And in step 4, we close the owner's withdrawals or dividend accounts to the capital account as well. After the closing entries have been posted, the capital account includes the results of operations for the period as well as their drawings and dividends. After this process is done, the accountants run a post-closing trial balance to prove out that the entire process was done correctly. To start, we'll continue using our textbook example of Eli's consulting to practice the closing entries. We first identify the temporary accounts, which are Trade and Eli drawing, account for $5,000, fees income for $47,000, salaries expenses $8,000, utilities expenses $650, supplies expenses $500, rent expenses $4,000, and depreciation expense $183. Let's zoom in on just that information and prepare the closing entries. Step 1 of the closing process involves closing out all revenue accounts and any other income statement accounts with credit balances to income summary. In our example here, there is only one revenue account and we don't have any other credit balances. So let's close out the fees income account, which has a credit balance of $47,000 by debiting fees income and crediting income summary. For the posting process, we look at the account fees income first and write the date into the date column. the word closing into the description column, the journal page J4 into the posting reference column, and $47,000 into the debit column. We now need to calculate the new balance in this account, which is 0. Next, we need to post the credit side of our journal entry, which we'll record in the account income summary. We'll write the date into the date column, the word closing into the description column, J4 into the posting reference column, and $47,000 into the credit column, and calculate the new balance in this account, which is $47,000. We update the journal entry to show the account number 401 for the fees income account and account number 309 for the income summary account, so that it is apparent that the entry was posted. After this entry is posted, the revenue account is 0, and the income summary account shows a credit balance of $47,000. Step 2 of the closing process consists of closing all expense accounts. And those accounts with debit balances to income summary. Expense accounts have normal debit balances. That means we have to credit these accounts to set them to 0. We do that by debiting income summary for the total of all expenses of $13,333 and crediting each expense account individually. Salaries expense is $8,000, utilities expense $650, supplies expense $500, rent expense $4,000, and depreciation expense equipment $183. We start the posting process with the account income summary and write the date into the date column, the word closing into the description column, the post ref J4 into the posting reference column, and $13,333 into the debit column. The new balance is $33,667. This amount serves as the first double check that you closed all income statement accounts. The balance in this account should be equal to the profit on the worksheet income statement. The second double check is when we prepare a post-closing trial balance later in this video. Next, we need to post the credit side of our journal entry, which we'll record first in the account salaries expense. We'll write the date, the word closing, the post ref J4, and $8,000 into the credit column. The new balance is 0. We now need to record the remainder of the credits. The next account is utilities expense. We write the date, the word closing, the post ref J4, and $650 into the credit column. We now need to calculate the new balance in this account, which is 0. The next account is supplies expense. We'll write the date, the word closing, J4, post ref, and $500 into the credit column. The new balance is 0. The next account is rent expense. We'll write the date into the date column, the word closing into the description column, the post ref J4 into the posting reference column, and $4,000 into the credit column. We now need to calculate the new balance in this account, which is 0. The last account is depreciation expense. We'll write the date, the word closing, the post ref J4, and $183 into the credit column. The new balance is 0. We update the journal entry to show the account number 309 for the income summary account and the account numbers 511, 514, 517, 520, and 523 for the expense accounts. After the second entry is posted, the expense account balances have been transferred to the income summary account, and the income summary account shows $33,667. For the third closing entry, we confirm that the income summary account matches the net income from the worksheet of $33,667, which it does. It's easy though to make a mistake, and this is just another checkpoint to say, hey, are you sure you closed all the income statement accounts? In our case, since it matches, we can now transfer the income summary balance of $33,667 to the capital account. We do that by debiting the income summary account for $33,667 and crediting Trayton Eli Capital. Post the third closing entry, we first look at the account income summary, write the date into the date column, the word closing into the description column, the post ref J4 into the posting reference column, and $33,667 into the debit column. We now calculate the new balance in this account, which is 0. Next, we need to post the credit side of our journal entry to Trayton Eli Capital. We'll write the date into the date column, the word closing into the description column, post ref J4 into the posting reference column, and $33,667 into the credit column. We now calculate the new balance in this account, which is $133,667. We update the journal entry to show the account number 309 for income summary account and the account number 301 for the Trayton Eli Capital account. After this third entry is posted, the income summary account balance is 0, and the balance of the Trayton Eli Capital account is $133,667. There's only one more closing entry that we need to record and post. Our last step is to close the last temporary account for Trayton Eli drawing to the capital account. In our fourth journal entry, we debit Trayton Eli Capital for $5,000 and credit Trayton Eli drawing for $5,000. To post this entry, let's look at the account Trayton Eli Capital first. And as we've done before, enter the date, the word closing, the post ref J4, and then the amount of $5,000 into the debit column. The new balance in this account is $128,667. And next we need to post the credit side of our journal entry to Trayton Eli drawing. We'll write the date, the word closing, the post ref J4, and $5,000 into the credit column. The new balance is $0. We update the journal entry to show the account number 301 for the Trayton Eli Capital account and the account number 302 for the Trayton Eli drawing account. After the fourth entry is posted, all temporary accounts should be closed. Accountants double check that all temporary accounts are indeed closed with the next step in the accounting cycle. The 8th step in the 9th step accounting cycle is the post-closing trial balance. It contains only the permanent accounts which were not closed at the end of the period when we posted our closing journal entries for the temporary accounts. We prepared this post-closing trial balance to prove out that our trial balance still balances and that all revenue, expense, and drawing accounts have a 0 balance. It might seem like an unnecessary step, but you've probably come to realize how easy it is to make a mistake. Accounting is all about checks and balances, so this is just an extra checkpoint to ensure that we're still balancing and that all temporary accounts have a 0 balance. If the post-closing trial balance does not balance, the accounting records contain errors, and that means that you will have to find the last point where your trial balance balanced and work forward to identify where you made an error. If you're asking yourself why you're learning this manual accounting process when this process is automated in most companies, here's the answer. You're learning the basics of accounting, and you will need to be able to understand what an accounting system is supposed to do. And even when a process is automated, mistakes can occur. For instance, at one company I worked for, a new expense account was accidentally set up as an asset account in the chart of accounts rather than an expense account. And because it was consolidated with other asset accounts, it did not become apparent until the post-closing trial balance was printed. The error was found because the trial balance typically is sorted in numerical order, and the expense account was listed toward the bottom of the trial balance with a balance. So mistakes occur all the time, and accountants need good processes to identify them. With that, let's get into what the post-closing trial balance looks like. This is the post-closing trial balance for Eli's Consulting Services, which is shown on the first line of the header section. The second line contains the title, post-closing trial balance, and the third header line contains the date, December 31st. Next, we list out all of the asset accounts and their balances in the appropriate column. And remember that the accumulated depreciation account is a contra asset account with a credit balance. Next, list all of the liability accounts followed by the capital account. And we then add up all of the debits and the credits, and both should equal. Your total debits do not equal your total credits. First, calculate the variance, meaning the difference between the total debits and the total credits. Does that amount seem familiar? Did you forget to list one of the balance sheet accounts? If that's not the case, divide the amount by 2 because perhaps you entered the amount on the wrong side, meaning a debit as a credit or vice versa. If that's not the case either, divide the difference by 9 to check if you transposed the number, meaning, for instance, you entered 540 instead of 450. If you still can't find it, go back to the last trial balance, and double check each account that you listed in the post-closing trial balance. With time, you will develop a sixth sense for where you made a mistake. A good approach is to work slowly and double check your work along the way. This way, you won't have to spend a ton of time finding your errors. I hope this video helped you understand the closing process in a manual accounting environment, and you now feel more confident in recording and posting closing entries and preparing the post-closing trial balance.